The U.S. stock market is facing a critical moment as chip stocks experience their steepest decline in over a year. This sell-off raises urgent questions about the sustainability of the AI-driven rally that has lifted markets in recent months. Looking ahead, the coming week is poised to be pivotal for the stock market, particularly as U.S. corporate earnings season gains momentum. Major players like Alphabet and Intel are set to report their quarterly earnings, which could significantly influence the market-leading AI trade. Historically, these tech giants have been barometers for market sentiment, and their performance often sets the tone for investor confidence. If these companies fail to meet the elevated profit expectations that investors have set, the ongoing chip sell-off may deepen, potentially pulling the broader market down with it. The semiconductor sector, already under pressure from geopolitical tensions and supply chain disruptions, could face further turmoil if earnings disappoint. This sector has been grappling with challenges such as trade restrictions and fluctuating demand, making strong earnings even more critical. Conversely, robust earnings could provide a much-needed boost and stabilize the current narrative surrounding AI investments, which have become a focal point for tech enthusiasts and investors alike. Enthusiasm for AI technologies has surged, driven by advancements in machine learning and automation. A positive earnings report could reignite enthusiasm and restore momentum in this sector. Additionally, investors are keeping a close eye on upcoming economic reports, including the Fed's Senior Loan Officer Opinion Survey, SLOS, which could provide further insights into the economic landscape. This survey is crucial as it reflects lending standards and credit availability, key factors influencing consumer spending and business investment. As money market funds adopt a more cautious approach, the market remains on edge. The next few days will be critical in determining the future direction of the stock market, with the potential to either restore confidence or deepen uncertainty. The outcomes of these earnings reports could reshape investment strategies significantly. The current stock market turmoil can be traced back over several months, with key events leading to today's significant sell-off. In recent weeks, the market has been grappling with uncertainty surrounding the Federal Reserve's rate policy. Fed Chairman Kevin Warsh has emphasized the critical need to control inflation without providing clear guidance on future interest rate adjustments, leaving investors anxious and uncertain. Earlier in July, a soft consumer price index inflation report provided a temporary boost to tech stocks, sparking optimism among investors who hoped for a sustained recovery. However, this rally proved short-lived as underlying economic pressures, including rising commodity prices and labor costs, remained persistent. The rotation out of chip stocks began gaining traction as investors reassessed their strategies following a two-day bounce earlier in the week. Many began to fear that the surge in AI spending, which has been a key driver of growth, may not be sustainable in the long term. This situation mirrors past market corrections, where over-reliance on a specific sector led to significant declines when reality did not meet expectations. Understanding these historical patterns helps frame the current crisis as a potential warning sign for investors about the volatility inherent in tech-driven markets. The impact of this sell-off could ripple through the broader economy, affecting consumer confidence and spending. As companies brace for tighter financial conditions, the outlook for the tech sector remains uncertain. Investors are already witnessing increased caution among consumers, which could lead to reduced spending in the upcoming holiday season. The trajectory of interest rates and inflation continues to shape the economic landscape in the coming months. Analysts suggest that if the Fed remains aggressive in rate hikes, the tech sector may struggle to regain its footing, prompting investors to diversify their portfolios away from technology and towards more stable industries. The recent sell-off in semiconductor stocks has sent shockwaves through financial markets, raising critical questions for investors and the overall economy. This downturn follows an impressive market rally driven by advancements in artificial intelligence, which had previously buoyed tech stocks. However, as chip stocks plummet, doubts about the sustainability of this AI-fueled growth emerge. Investors are increasingly concerned that companies may struggle to meet the elevated profit expectations that have been driving stock prices higher. The tech sector, particularly firms capitalizing on AI technologies, is now facing intense scrutiny from analysts and investors alike. The context surrounding this sell-off is multifaceted. The semiconductor industry is crucial for powering not just AI innovations, but also a wide range of consumer electronics, automotive technologies, and industrial applications. The global economy has become heavily reliant on these chips, which serve as the backbone of modern technology. Furthermore, geopolitical tensions, particularly the ongoing conflict involving Iran, add layers of uncertainty to the market. Such instability can disrupt supply chains and exacerbate existing challenges in the chip market, leading to production delays and increased costs. Consequently, if the decline in chip stocks persists, it could lead to a broader reassessment of valuations across the technology sector, potentially triggering a market downturn that impacts various industries. The implications of this sell-off extend far beyond stock prices. For institutional investors managing billions, the repercussions could mean significant losses or shifts in investment strategies. Individual retail investors, many of whom have turned to tech-focused portfolios in recent years, may face declines in their retirement accounts and investment portfolios. The ripple effects could also stymie corporate investment decisions, resulting in a slowdown in technological advancement and innovation that has been a hallmark of recent economic growth. Looking ahead, the technology sector must navigate this turbulent landscape carefully. Analysts will be closely monitoring earnings reports and market reactions to gauge the resilience of companies amid these challenges. The current environment suggests that investors may need to adjust their expectations and strategies in response to shifting market dynamics. Ultimately, the future of tech investment will hinge on the sector's ability to innovate and adapt in an era marked by uncertainty and volatility, with a particular focus on sustainable growth strategies. On July 19, 2026, U.S. stock index futures fell sharply, driven by an accelerating sell-off in chip stocks. This decline marks the steepest weekly drop for these stocks in over a year. Futures for the S&P 500 dropped by approximately 2.2% as the impact of the sell-off deepened. Major chip manufacturers, which had previously been the darlings of the market, are now in a precarious position. The sell-off was exacerbated by disappointing earnings forecasts from Netflix, which added pressure to an already struggling market. Investors had hoped for a strong performance from tech giants, but Netflix's lackluster results sent shockwaves through the sector. This reversal comes after a brief respite for chip stocks following a softer consumer price index (CPI) report on July 14, 2026, that had initially buoyed tech stocks. The rapid shift in market sentiment underscores the fragility of the recent rally, particularly as investors reassess their positions in light of ongoing geopolitical tensions, notably the uncertainty surrounding the Iran war. This moment is particularly striking given the previous optimism surrounding the AI sector, which had driven significant investments in chip technology. The current sell-off is not just a market fluctuation. It signifies a potential turning point for investor confidence in technology stocks. Analysts are now warning that the decline may signal a broader reevaluation of tech valuations as interest rates remain high and economic growth slows. The implications of this downturn are profound, as many investors had banked on continued growth in technology to hedge against inflation and economic uncertainty. Looking ahead, market analysts suggest that the tech sector may experience a prolonged period of volatility as investors grapple with the dual challenges of disappointing earnings and global instability. The once unshakable faith in chip stocks, bolstered by AI enthusiasm, is now under scrutiny. As companies prepare for upcoming earnings reports, the market will closely monitor how these tech giants navigate this turbulent landscape. The next few weeks will be critical in determining whether this sell-off is a temporary setback or a sign of more significant challenges ahead for the technology sector. Investors should brace for potential shifts in strategy as they seek opportunities amid uncertainty. As we watch the unfolding situation, what do you think will happen next for the stock market? Share your predictions in the comments below, and subscribe for daily deep dives into the latest financial news.